Why I can't stand fixed index annuities, structured products, or anything that doesn't reinvest dividends. Folks, if you want stock-like returns, you've got to be in the stock market, which means you need to be reinvesting dividends. There's no other way around that. Fixed index annuities, structured products sold by your brokerage firm through their bank with FDIC insurance, they don't do that. They don't reinvest dividends. They do price to price, point to point, cap rates, all this stuff, which we don't reinvest dividends. And if you want stock-like returns, you have to be in the stock market. That's it. End of story. You cannot be in the market and expect to get stock-like returns if you have some kind of insurance mechanism to protect you from the downside. You can't. The only insurance mechanism you should do in that case would be puts. But to get a dividend not to be reinvested and to assume that that's not that big of a deal, well, I'm going to prove it to you right now. All right, so let's take my trusty PVC pipe. Here we are in 2019. This is AT&T stock, ticker T, as in Tango. 30 August 2019, AT&T stock is trading at $35.26. 100 years ago to the day, American Telephone and Telegraphic, or whatever it was, AT&T. What was it trading at? Anyone want to guess? So here's 35.26. 100 years ago to the day. You want to take a guess what it's trading at? I'll share it with you. 110. I don't know the exact. It used to be traded in eighths, so I don't know what it was. 110. All right. So if I bought AT&T 100 years ago, have I lost a third of my assets? That'd be silly. It's silly to think that way. Because I got all the dividends that were reinvested. I got the dividends. I reinvested them. And so regardless of what the price was then and what the price is now, I made a boatload of money. I'm a wealthy, wealthy man if I bought 100 shares of AT&T 100 years ago. I'm old, but I'm wealthy. Multi-generational wealth, my friends. Multi-generational wealth. What does fixed index annuities, structured products do? Point to point or price to price. It doesn't matter. So they start with the price today. At the end of a certain period, they look at the price there. And they give you a percentage of that return based on point to point or price to price. So if you would have bought AT&T on a fixed index annuity 100 years ago, you would have lost 2/3 of your portfolio value because you didn't get dividends reinvested. Most of these things do not reinvest dividends. That's actually essentially their fee. So a lot of these guys say, we don't charge a fee. The hell they don't. The fee is by the dividends not being reinvested. And I've shared with you before, dividends have represented about 40% of all returns historically of the stock market. Not reinvesting dividends, you're leaving 40%, not just 40% on. So if I had $100 and I got a $100 return, I only got $160. It's compounding year over year over year over year over year. Not to have dividends reinvested compounding it's just, why even be in stocks at that point? Now, some people will argue that fixed index annuities will give you potentially a better return than bonds. I get that. So if a salesman is offering you a fixed index annuity as a bond replication or a bond substitute, I'm somewhat interested in that argument. I don't see that happen that much. I see a lot of people say we're going to give it stock-like returns without the risk. It's not going to happen, man. It's not. And the minute they start saying stock-like returns without the risk, I know that they used to have this thing back in the day called portfolio insurance back in the 80s. Obviously, they had variable annuities with all their different risk mechanisms, whatnot, back in the 90s and going into the 2000s. Fixed index annuities and stuff, again, it's all the same thing. It's all this similar fraud that they can give you stock-like returns without the risk. It can't happen. You've got to have the dividends reinvested. You've got to have no upside limitations. You cannot get stock-like returns without the risk. You've got to accept both. Now, if you want to say again, the structured products should look as a portion of your fixed income portfolio because you're not happy with a 3% corporate bond right now, and you think the structured product that has access to stocks through price to price right here, no dividend reinvestments and caps, that's fine. But do not sit there and fall for the idea that you could get stock-like returns without the risk. Now, I'm telling you, they'll show you all kinds of hypotheticals. Say, if you would invest in this in 2000 when the markets fell, okay, that's fine. But that's an exception to the rule. There's always an exception to the rule. I mean, why not start in 1982? If you would invest in this fixed index annuity in 1982, it'd be, I mean, it's silly. Silly on its face. Say, how about year over year over year over year? But it doesn't. I don't even care. The facts are, if you want stock-like performance because you're a long-term investor, you cannot give yourself an upside limit with this price to price or point to point. You've got to get the dividends. They've got to be reinvested, and you cannot give yourself a ceiling on the growth of the market. So what happens is a lot of these fixed index annuities, I hit my funny bone. It hurts like oosh. Fixed index annuities, structured products. Again, those are FDIC insured banks that have exposure to the index, whatever. Not only do they not give you a dividend reinvestment, but they'll say, look, we'll give you zero guaranteed floor, but if the market goes up 20, we'll only give an 8% upside. And you're like, hey, at least I get 8, and I don't get anything on the bottom, so 0 to 8, that's not so bad. No, because what happens is the market doesn't ever, hardly ever, give you anywhere near between just 8 and 10% rate return. It'll be way up, way up. In fact, I've done many videos. Vanguard does this study. When are we going to get back to normal returns? And if you look at the stock market, if the average return of the S&P 500 since 1926 is 10%, it's only like 5% of the time has the actual S&P 500 with dividends reinvested giving you between 8 and 12%. That's it. It's much higher on the upside. It's much higher on the upside. It's true. It's much lower on the downside too. But the facts are, when you're in the stocks, it's the getting that time, those couple years, actually it's really just a couple days, when it blows through the average, that's where the money is made. That's where the money is made. If you're putting a cap on that and then you're capping your dividend reinvestment, don't do that. There's nothing wrong with being a safe investor and buying bonds and CDs. I don't like bonds, I said, but CDs for sure. But don't use your stock money in a bond-like portfolio, because you're not going to win that way. Unless you literally are okay with subpar returns relative to the stock market because you don't want to take the volatility. That's fine. But do it for the right reason. Say, I don't like the volatility, or I don't need the volatility. I'm okay with bond-like returns, but I'd like to get a little bit more than just a bond. I recognize I will leave a lot of money on the table. That's absolutely acceptable. Just know what you're going in there for, and what you're going in there for in the fixed index annuity structured product isn't stock-like returns. It is bond-like returns you're hoping, and potentially even more so than bonds. I had a guy, he said he thinks fixed index annuities are guaranteed to beat bonds. He said, probably be stocks. I said, whatever. I sat there. I said, you can't say that stuff. Anyway, so just again, going back to AT&T, is at 110 in 1919. Is at 35 100 years later. If you did price to price, you lost 2/3 of your portfolio. If you bought AT&T in 1919, you are sitting on a pile. You are Mr. Scrooge McDuck. That's who it is. You are sitting on a pile of gold, and you're lighting cigars with $100 bills. All right, we'll see you next time.